Hello and welcome to Money Control. Well, we take forward our Diwali special conversations series co-presented by Motilal Oswal. Last year, of course, was a fantastic year in the sense that the frontline indices did well. We climbed new highs. The small and mid-cap party was well alive and kicking. How is this year going to pan out? How should investors position themselves? We have a very special guest, Manish Chokhani, Director of Enam Holdings. Manish, thank you so much for joining me on this discussion today. This year has been especially surprising, I guess, for most of the market participants because we had a series of risks sort of emerge on the horizon, but nothing sort of did impacted the market at all. When do you remember seeing this level of resilience before 2020? How would you describe this year?
I mean, it's always tough to say this time is different. But it did feel like this time is different.
Right.
And something we waited for decades, that the Indian investor would be a counterforce to the foreigners who would run the market at their whims and seas. And the power of retail, first time we've truly experienced it. I'm just so happy that of the 5.5 trillion market cap, 85% sits with Indians. That wealth creation which has happened here is unprecedented, and that gives you a stock of growth ahead for the economy. And I was just sitting and mentally doing the math that we probably still have a lot more money in real estate because most of it is unlevered. So at least 5 or 6 trillion worth of real estate. There's at least $2 trillion of gold. And let's say there's $4.5 trillion worth of stock in people's portfolios.
Right.
Apart from what they have in bank deposits. I don't think the banking sector assets are more than $3 trillion. So if you put this together, the average Indian has got wealthier, and that's just very gratifying to see.
And what does this mean, this mix of where we are in terms of how much is invested in real estate versus gold versus stock markets? Does it give you the confidence that liquidity as a driver will continue to propel markets?
The markets always tend to, pull returns forward. And this kind of extraordinary returns that we've seen, I think the index, if I'm not mistaken, was 7,000 at the lows.
Right.
And we are at 25,000 or whatever. So it's more than 3 times in the last 4 years.
Correct.
Normal earning growth in India allows you to double every 5 years. So you would go 4 times in a decade. We are about 3.5 times already in 4 years, albeit from a low base. So it's not like there's that much juice left in the markets per se to say that we'll arrive at our destination, say by 2030, with more than double from here. If we do that, it'll be great. But in 5 years to just double is not exciting enough seeing the past. But it's also a fact that when you pay 100 and 150 multiples for a number of companies, the returns tend not to come for a long period of time.
Correct. But you don't see, do you see, you're talking about multiples, do you see multiples evenly being higher across the board? Because if you look at some of the large stocks, whether you see Reliance or you look at HDFC Bank, some of the index heavyweights, you don't get the kind of feeling that you see when you look at, the rest of the market.
No, it's true, and let me break that down for you a bit. So, of the NSE 500, and let's say I'm just approximating to $5 trillion, there are 11 companies which are 25% of that. So, $1.2 trillion odd dollars, and the average company is over $100 billion there.
Right.
So, it's obviously that much harder to create compounding on that base. Like Reliance, I think ROI is now single digits.
Correct.
So, to expect that stock to be delivering performance much ahead of its ROI for a long period of time is difficult. Unless the returns follow. You come to quartile 2, which is say the next 30 companies. So 30 companies will be an average of $1.2 trillion. So gives you what, $40 odd billion is the number over there, where enough wealth has been created. Quartile 3 is about another 80 odd companies, and again $1.2 trillion, so about 14 odd billion dollars there. But the tail, which is 370 companies, that's the $3-4 billion market cap, 25,000 crores, which is now the definition of a small cap in India. That's where the whole action has centered around.
Correct.
And that's really where a lot of the excesses have also happened, because in this euphoric rise, they're chasing momentum of earnings now and forgetting that there's a price to pay for everything. And I always give this example that you can have the best company in the world, but if you pay the wrong price, you spend decades correcting for it. In the 90s, there was Hindustan Lever, which you will remember also. Till 98, it was 3,000.
Correct.
And then the next 12 years, it spent recovering that same price.
Correct.
The same thing, our favorite company, Infosys, where a lot of us made our fortunes. It peaked at a $45 billion market cap in March 2000.
Correct.
And it's today somewhere north of 90 billion. So it's doubled in dollar terms,
Yeah.
which means it's say 4 times in rupee terms.
Right.
In that period, the index is up 14 times.
Correct.
So you can be in the best company and not make a return. Same way, the leaders of the 2000 to 2008 bull market, the Reliances and all of the world, as you're saying, did not participate till 2020.
Correct.
And then, of course, it went 4 times.
Right.
This bull market also, if you look back, were the laggards of the 2008 global financial crisis. So real estate, infrastructure, power, capital goods, they didn't do anything for the last decade, and then they've come roaring back in the last 4 years. By the same token, the leaders of the last bull market of 2000 to 2020, which was HDFC Bank, Kotak Bank,
Yeah.
Bajaj Finance, Nestle, Page Industries, they've not delivered returns
Absolutely.
commensurate to what the market has done now. But this is a cycle which plays out.
Right.
And I would expect in this cycle, you will get a lot more money going back to the so-called perceived laggards. Like there were memes going around on ITC.
Yeah.
You remember? And then it
Yeah,
just doubled
yeah.
and no one
Correct.
noticed it.
Correct.
People didn't want to touch Coal India because it was a sort of ESG hated stock.
Correct. Correct.
And Coal India miraculously gives you return.
Right.
And I suspect the same thing is happening to banks because it happens to be $1 trillion market cap roughly. And most of it is float. So it takes a lot of money power to pull those market caps up. But if you see conversely, while we say banks haven't done well, when I look at PSU banks and my smaller banks, they've done spectacularly.
Correct.
And the so-called corporate banks of the last era,
Yeah.
ICICI, SBI, Axis Bank, they've done well.
Correct.
So, and the story may just be starting for a lot of these now. So you play these ebbs and flows,
Right.
and that's really the only way to be placed in this market.
Right. But the trade from 2020 to now, which is the value trade, like you said, the Coal Indias of the world, also all these thematics like Hindustan Aeronautics or the defense plays and whole bunch
I won't
of
agree they were value trade. They all had catalysts in a sense. And
Right.
if you recall, when I think we met now 2 years ago, it was clear even before COVID that 4 or 5 themes will dominate in India. One is you expected the rise of this Indian consuming class, so consumer discretionary, I think we were clear, and it's happened post-COVID, it accelerated the trend.
Right.
That you want a larger home, you want a better car, you want to go out on holidays, you want to fly in better aircraft, hotel stocks, all have done well, QSR.
Right.
So that's worked out well. Platform plays, which we said you want convenience, so whether it's shopping at home or dining at home or whatever, they've done very, very well. And this rise of value retail, for example, has done exponentially well.
Right.
So these two. The third we thought will be the privatization beneficiaries, because government can't do whatever it wants to.
Right.
So whether it was telecom with Bharti and others, the rise of Adani, of course, for example, plays
Right.
straight into that theme. Fourth was financialization, which everyone understood financials only as banks, but they forgot there's this whole capital market segment. I remember
Right.
on your own mega panel, I was the lone voice saying, AMCs and wealth is where the money is. And I remember Samir was on the show and he himself was like, what's wrong with you? Like,
Right,
this is
right.
not going to happen. But it's a trend which has accelerated due to COVID, and the rise of the Zerodhas and Grows have put the power in the hand of the young consumer. And the average investor in India today is 32 years old. 50% of investors now are 32 years old. They haven't seen a bear market in their life. So that played out well. And then government, of course, came with its own stimulus. So 3 things. They came out with this whole PLI scheme.
Yeah.
So you see the EMS guys, the way they've done.
Yeah.
The whole chemical, pharmaceutical chain, whatever they're trying to build up over there, and EVs and so on. They did the whole spend on infrastructure with road, rail, defense, build in India and so on, which also gave rise to the manufacturing theme. And third thing which they are trying, of course, very hard is to do the FTAs.
Yeah.
To do their export engine going, which hasn't unfortunately fired till now, but I'm hopeful
Correct.
it will. And then this whole energy transition, which is still playing out as we speak. So there were enough thematically things to go after in this whole period. And they go through the ebbs and flows, like I said. So some have been stretched to the hilt in terms of valuations, and the companies will perform, but the stocks may not
Right.
for extended period of time. And somewhere there are still opportunities.
Where do you think, amongst these themes, which ones do you think have really peaked out?
Lots of them, I feel, like real estate stocks, while the companies will do well, I think they've extended themselves way too high in terms of what the valuations are.
Right.
lot of the capital goods, like you talked of defense also, because
Yes.
now you know the incremental rate of change in defense spend, which comes from government balance sheet, is not
going to be.
is not going to compound. In
Correct.
fact, they've started diverting away to now welfare schemes.
Correct.
So if the rate of change is not there, and unless they now get into the export market and build out,
Right.
you will find natural caps there.
Right.
And some have, of course, already paid the price for it.
Right.
Some of the shipyards, for example, they're still fantastic on a year-to-date basis.
But they've already corrected
But they have
20-30%
already
for
corrected.
sure. Yeah.
So some of those may not play out. Some cap goods, while we're very bullish on this whole energy transition and the transmission space, but even you look at valuations for ABB, Siemens and
Yeah.
companies of that ilk,
Correct.
it's to a price where GE came and sold its stake down in India.
Yeah,
And the
yeah.
stock doubled even after that.
Correct.
So even I've spoken about on the consumer side that we've extended this valuations for the darling stocks
Correct.
on consumer discretionary also. Now,
Yeah.
whether you call it retail, whether you call it these Zomatos of the world, they're all fantastic companies, but I think investors are paying a very, very high price
Right.
for just sheer momentum over there now.
Right.
And Mark Faber used to famously say this about Nokia in the 2000s, that it's a consumer durable with a high growth rate. When the growth rate slows, it'll come back to consumer durable kind of pricing.
Right.
And that I suspect is what will happen to a lot of these high flying stocks today.
Right. And what's your take on PSUs?
So
Is that
PSUs again
also-
is not a basket, because you had these capex heavy PSUs. The energy ones haven't really done well. The metals are still gearing up to go, and the PSU banks have only compounded at rate of earnings.
Correct.
I mean, they're still at book value. They're still making their 15-20% ROEs.
Yeah.
And they're still trading at 5 multiples. So there is value over there. And as this cycle plays out, surely, some of the others will catch up at different points in time.
So there is still room left, you're saying, in
Yeah, it's not-
PSU
it's-
banks particularly,
it's
I'm
not-
asking
it's
because
not-
that's the...
So again, it was such a hated space
Yeah.
that you say these guys misallocate capital, they will blow
Yeah.
it up and so on and so forth. For that fate to come,
Right.
like it came in capital goods and real estate,
Right.
hopefully it comes there as well. And I do have a couple of holdings in PSU banks.
You do. Okay. How about private banks? I mean, so much has been talked about, the
Again,
likes
like
of
I said in the
Kotak
beginning,
and-
that you had the so-called quality banks, which was
Yeah.
Kotak, HDFC, and so on, and they didn't participate. And the performance then shifted because the rate of change in the ICICIs and the Axis banks and all was much greater. And they've caught up, but really still on earnings. ICICI, of course, has re-rated. Axis still hasn't re-rated, for example. Then you go to the smaller banks, where you had this whole euphoria of the public on, say, a Yes Bank.
Yeah.
And they were ignoring the other banks because it's a low ticket size at
Yeah.
20 rupees. But they forgot that the equity base has expanded dramatically. So some of those suffered, but there are others which are performing reasonably well over there. So banks, again, you can't generalize, because while HDFC was not performing, ICICI was.
Correct.
And the same may be the case in the future, that say even Bajaj Finance hasn't really performed for a while.
Yeah.
And it may be time where it's revving up, and you get the next burst over there as well.
There's one set of market experts who believe that, the financial sector is right now, you're seeing a lot of aggression from RBI in terms of regulating in the industry, and that may be playing in the minds of investors, and that's one of the reasons perhaps.
We find reasons for stock performance. When I've seen reports now come out where they are forecasting earnings to 2030 to justify prices and higher target prices. I think fact of the matter is banking, the whole sector, it's about $1 trillion worth of market cap, and almost all of it is float. So to get that kind of lift off over there is not easy, and therefore you saw the action. It's not like people don't like banks. If I see 60 lakh shareholders in Yes Bank, it's not that they don't want to buy a bank. They just want to buy a bank which can jump faster.
Right.
And
right.
it doesn't happen in
By
life.
the way, Yes Bank is the bank with the largest shareholding, number of shareholders.
I follow 3 companies, and again, no disrespect meant to anyone. That Yes Bank, Idea, Vodafone, and Suzlon.
Yeah.
I think there are 60 lakh shareholders.
Yeah.
I'm not sure everyone knows what they're doing and buying there, but
correct.
I mean, if they are, good luck to them. And some of these have done well also for them, but clearly the vision of the investor there is greater than that of the promoters.
Correct. Nicely put. Manish, just pulling back a little, I want to talk about liquidity. We started off saying that liquidity has been the greatest driver, and Indians are placing faith. One important thing is that a lot of businesses, and this is something I picked up more recently, but I'm sure you've tracked it for a longer time, that a lot of businesses that got displaced after the GST, those entrepreneurs had a lot of cash, and that money was like a very important driver of liquidity into stock markets. 4 years, actually more than that, because it was 2016, right? So thereon, that liquidity started flowing into the stock markets. Do you think that has played out? Is there a way to estimate how much of that is really propelling markets? Is the SIP, the way we think about it, is it really the middle class salaried people contributing to that kitty that will continue to rise whether the markets go up or down? Is there a threat you see there?
Typically, a businessman is not going to do an SIP. But they will start coming with lump sums. It's probably a reality that 2-3 things are happening. Number one, a lot of businesses have indeed got displaced with the formalization of the economy. And for those people, maybe the stock market and the F&O segment has become a source of making money. Almost too easy for the last few years, but I hope it doesn't end up hurting a lot of people. But the reality is we've had an asset allocation shift going on in India. For years I've been arguing that we have, say, a 25-30% saving rate. So on our current, say, $4 trillion, we save at least $1 trillion a year. Half of it is still going into hard assets like real estate and gold.
Right.
We are still putting maybe $75 to $100 billion in gold every year. The stock markets are getting $50 billion a year.
Right.
Through this whole SIP scheme and whatever. So it's not that all the money of the world has come to the stock market.
Right.
It is a shift which is occurring. And like I said in the beginning, a lot of wealth in the past used to be in real estate, which people are realizing we can unlock and create capital from it to use to grow.
Right.
A lot of money historically has been indeed in gold, which because of the way the rupee has depreciated, in fact, gold has given the same returns as the index over the last 20 years. So all the hard work, most people do, it was better off if you just bought gold or you bought an ETF and sat down. A third part of it is the banking deposits. I don't think, if I'm not mistaken, is in excess of few $1 trillion. So to get to this $4 trillion wealth creation in the stock market is something which is unparalleled, and it's not a trend which will reverse easily. Even if you now have a 2008 type event, it will be a setback. But if we can keep compounding in India at this 13% type earning growth rate with this 11% type nominal GDP growth rate, remember that 90% of our market cap lies ahead of us in the next 20 years. And the average investor, like I said, is now 32 years old. So we will inevitably have setbacks. We will inevitably have time corrections. But it's not like this story is to be juiced today and then forgotten forever.
Right.
So I won't be in that camp. I'm certainly concerned that valuations are ahead of reality. And if we have, say, a consolidation period for a year to digest this, and we let earnings catch up, and we do some right things. It's not a God-given gift to India that we are bound to grow if we don't do certain things.
Right.
But all things being equal, the odds are that you will still compound at double digit.
Right.
And it's still better than making 6% in the bank with the full tax rate.
Correct. So a lot of, another thing is that, after the pandemic, it's almost like every dip has been bought into. This year particularly has been a great manifestation of that. Is this a new normal? Are we ruling out a bigger than 10% correction because the domestic liquidity seems to be so strong?
It's a fair question, and I'm being underwhelmed, to be honest, about the foreign flows into India. I was in the camp that I thought we will get this $40-50 billion plus the EPFO flows, LIC flows and all. And in the world, remember, for the last 50-60 years, ever since we broke the gold standard, the excess money printing has led to bubbles in every decade. In the 60s, you'll remember it was the Nifty 50 stocks, the Xeroxes and the Disneys and so on. 70s, we went to gold and silver and oil, which peaked. The 80s, we went to Japan and Taiwan, which were those times emerging markets. 90s, we went to NASDAQ. 2000 to 2010, we went into the whole China bull market with commodity bull market and the era of BRICS, which was really China sucking the whole thing out. 2010 to 2020, we went back to technology and the rise of FANGs, which has now got extended with again money printing post-COVID. But this decade should be logically the era again of emerging markets and hard assets. Like I would be very, very bullish on say gold, silver, uranium, stuff like that. It may not be iron ore and all, but it will certainly be on this side of the foot. And emerging markets, not just India, but countries like Indonesia, all of them are bound to do well. In that context, I had thought that we will get domestic flows and we'll get foreign flows and make India the center of a melt-up in this decade. So I was expecting that this market will rise to unbelievable levels. It's risen so far only on the back of domestics.
Yeah.
And the foreigners, in fact, have come and sold.
Right.
So if I look across the world from GE of America and Whirlpool to the UK where Vodafone and BAT have come and sold down, to Japan where Sumitomo has sold down, to even the Koreans, Hyundai, now Samsung to follow, to Singapore where even Singtel has come and sold down.
Totally.
And even Indian promoters, Tata Sons has sold TCS, Vedanta, promoter has sold down his stake, and so many more.
Yeah.
So the fact is that demand-supply balance has come kind of close to each other. In the last 6 months alone, fresh capital for business raised has been about $15 billion. But promoter and PE selling has been $15 billion.
Correct.
So that money is not going to fresh capital creation. It may at best come back in the stock market.
Correct.
But it's not creating new capacity for you.
Yes.
So if this balance tilts, you can get a setback. But it's not like the capital creation process of India is over. The engines are still there. And it's no longer maybe putting up a steel mill, but I'm certainly putting up data centers. We are certainly putting up a lot more power plants. We are certainly putting up a lot more semiconductors, certainly a lot more money going into build out of ports and infrastructure which the government was not doing. So capex is happening, but it's happening on a different place. So I would hope that we don't get a sharp correction, which I do think will be for external reasons, not so much internal. But having said all of the above, I'm underwhelmed with the amount of foreign flows into India.
You expect that to reverse?
So I've been thinking about it, that why is it not occurring? And then I realized that other than the big tech, who are all here, actually, all the Amazons and Googles and Nvidias, they're all here. And the old economy hasn't actually been doing that well. And they've been doing buybacks and raising their debt profiles. So they're not so much in a mood for capex expansion from the so-called developed West. And you're seeing a plethora of companies in Europe getting sold out, as those people are kind of putting their hands up. You would have actually the largest FDI investor in the world now is China. And we are not the best friends with them.
Correct.
So they are finding ways to come around that MG Motor will tie up with JSW, BYD will tie up with one of the large industrial houses, and they'll come here. But until that relationship is sorted, it may not be that easy to think of hundreds of billions of FDI coming in over here. But I have my fingers crossed. I'm also underwhelmed that we haven't managed to sign the breakthrough FTAs, which we need. We can keep dropping the rupee to 90, 100, 200.
Correct.
But if you don't have that advantage which other countries like Vietnam, Bangladesh have with the FTAs, and you're not part of global supply chains, just being cheap is not going to help you to get your export market share up. So let's see, all this lies ahead of us.
So you're talking about FDI. What about FII, portfolio flows? Because that also, I think, from 2020 to now onwards, nearly $7 billion has moved out. If you just count out the IPO markets, look at only secondary markets, there's a huge amount of money outflow that has happened, right?
So number one is in your home market when you're making so much money by doing nothing.
You don't need to explore.
If in India you could just make money by buying Reliance, ICICI, HDFC Bank and Infosys, would you think I want to go and invest in Sri Lanka?
Correct.
In the context of the world, if US is $60 trillion market cap, we are at 4. You make more money on Nvidia in a week than you would do in the whole year in India. So I think it's become a bit hard for those.
And you do nothing, you still get 5%.
Number two, we were not really part of the global indices, and emerging markets as a category died. Because of the blow up of Russia and China. Russia even.
Russia also, correct.
It became uninvestable. So people don't really have India specific funds. So unless you come into global indices, like it happened with the bond indices, and we'll still be 3-4%. And at 3-4%, the spectacular outperformance is done. So it's not like the fund manager loses his job if he's not in India. But that money will come, and our share of world market cap has to go up. US cannot remain at 60-62%. So some of these corrections lie ahead of us. I still think a wall of money will head our way, but it may surprise us that it may head into other emerging markets like Indonesia, Vietnam and others as well, not just here. and we need to rise as a class together. And I do think also this decade we will see a lot more money going to hard assets, precious metals and so on, because of the way they are debasing the G7 currencies.
Right. So what will be the trigger for that? I mean, would you say an accelerated rate cut in the US? What would be the trigger?
See, the US is clearly over-exploiting now its position as the financial superpower of the world. And the canary in the coal mine is going to be, I think, UK, whose trade deficit, balance of payments and fiscal deficit is like a third world country now. One bond market failure, I think, sets the cat among the pigeons, because all these currencies are trading in a tight band against each other.
Right.
You've seen the mess in Japan,
right,
where the Japanese central bank now owns a significant percentage of the stock market,
right,
and with zero interest rates. So that's a pool of capital. I honestly expected the Japanese to be putting $1 trillion in India,
right,
which should come. The Koreans, when they take $3 billion back from Hyundai, they will realize, hey, there's money in this market. The way when Warburg Pincus sold out of Bharti in the early 2000s, it opened the wall of money for P.
Correct.
Some of this money going back actually will create cheer and allow that money to come in here. But I don't know, on balance, I'm just in wait and watch. Let's see what the trigger is. I do think, but there's a debt market event likely to occur in the world at some point, sooner rather than later now.
Sure.
Which should be the trigger.
Okay, fair enough. Okay, earlier you talked about, the last quartile, right? Small mid caps. So there has been again this narrative that the resurgence of small cap, mid cap also came on the back of very strong earnings growth. And that in part at least was triggered by this, flow of business from the unorganized sector to the organized sector post GST. Is that a sustainable trend? Or you think earnings contraction is just around the corner? No,
contraction is too strong a word. So earnings have certainly slowed down. And the reality is if GST is grown at 6.5%, and it's another mystery to me that when maybe 70% of India GDP is taxed on GST, if you take 70% and you take the median rate as say 15, GST collection ought to be 10-11% of GDP. We are closer to 5 than to 10. So is that evasion happening, or do we still have things out of the net? I don't know, but it seems a very, very large number, which is still escaping, in a sense, the tax net, unless my math is totally wrong. I don't think it is. So corporate tax collections have held up dramatically well. Income tax collections have held up dramatically well. It's the GST which is underwhelming.
Yes.
And that is what should be giving ammunition to the government to spend more.
Right.
Number two, second-gen reforms of the government, which ought to have occurred. Number one being privatization. That is, with this bull market, you cannot privatize and disinvest and use that money for new asset creation. It's not the government's job to be running businesses, but the government certainly, if they get 3, 4, 5 times of their book value on their assets, which today would be 30, 40 multiples, surely you would take that, put it back into creating new assets, and again then recycling it at 30-40% compounded returns, which hasn't strangely occurred.
Yeah.
We still strangely haven't got our labor reforms, which should happen through the state. We still haven't got the regulatory cholesterol out of the system, judicial reforms, and a lot of this is holding back industry from becoming global in size. Because you'll put up 5 plants instead of 1 mega plant and get economies, because you don't know deal with regulations and labor and unionization and so on.
Right.
So I think the next trigger, say from the government side, would be things like that. From export side, it has to be about FTAs. It has to be about renewable energy, nuclear, solar and so on. And one would want to make investments keeping these kind of mega trends in mind. And from the consumer side, this asset allocation shift and living like you only live once has become the mantra after COVID.
Right.
That has to percolate down as kind of more and more wealth and jobs get created down the strata, because it is that trickle-down theory is clearly working in India.
Right. And tell me, this disinvestment as a term seems to be a forgotten term. I mean, at one time, this is this used to be the dominant theme we used to talk about. But so, do you see that coming at all? Coming back in focus? Because I mean, if they had to do it, there were 10 good years to do it.
So it's a disappointment to me, I must admit. There are 2 things which I'm very disappointed about, although I love what this government has done on most things. Number one, by not doing this privatization and recycling this money
Yeah.
to create velocity in the economy and recycle, because they got a free pass in a way after COVID.
Correct.
When you said you can blow the fiscal deficit to 6, 7, 8, 9% of GDP and the world won't notice because they're doing it as well.
Right.
That won't last forever.
Right.
And as you pull that back, that's what gave you the fillip to do the infrastructure spend.
Yeah.
But as you pull that back and you now have to start diverting money for electoral reasons, for welfareism, you're going to get a shock to the system from that. And the only way to counter that will be this. The second big vulnerability of India has been energy, and we haven't really moved. Despite signing the nuclear deal in 2007, we are still, like China is doing 50 mini nuclear plants a year now. India is still thinking, and we probably will 3, and I don't know how long it will take. Or even solar, which the Prime Minister has put a big thrust, but it's not big enough, large enough to satiate our energy needs, and we haven't certainly drilled for any oil for I don't know how many years now. So unless we solve energy, and unless FTAs are signed and swap agreements are signed with countries, so we don't have to build this stupidity called reserves, where a poor country like us is lending money back to Americans and Europeans to make 2% rates on currency which our entire reserves are printed by America in 6 months. It's just paper printing, which we are holding.
Right.
So if we had held it as hard assets even, maybe we had bought oil fields, or we had held our reserves in gold, we would have been in a different trajectory.
Correct.
Third, this consumption shock is because income levels have got debased. Your motorcycle of 40,000 is now 1 lakh rupees because the rupee has collapsed.
Right.
So then it's a mystery to us that why are consumers not coming, and why is inflation there? Because if you depreciate the rupee and you keep inflating by bringing in imported inflation into the country, you will never solve this problem. And the rupees become a one-way bet. That it only goes down. Volatility, I thought, meant going 2 ways. Ours only goes 1 way. I never seen the rupee go up 3%.
Hope for that to change for sure.
So someday, I think privatization and rupee appreciation are 2 themes I'll carry to my grave.
I know that you
I will
have been
never give
talking
it up.
about appreciation for the longest time.
It will happen.
Because of the import intensity. And
like they say, the entrepreneur has to stay lucky, till he stay alive till he gets lucky.
Right.
Same way the investor has to stay optimistic about the 2 big change drivers of India, which someday will happen in our life, I hope.
Sure.
Meanwhile, they're doing a great job, so I
Right.
have no complaints on that front.
Right. Okay, we were talking about small cap, mid cap, the story of earnings. So you said you don't see any contraction in earnings, but you see a significant moderation in earnings in that space.
So like I said, look, our trend line earning trajectory is 15% in a capitalist society. People don't allow you to make 20, 30, 40% returns in the business for long.
Right.
And ultimately, like they say, the man and the dog, you have to follow the dog in terms of where the earnings are going. Because we keep saying where the man, or maybe I said it the other way around, the dog on a leash can run anywhere.
Right.
But where the man is going is really the earnings.
Right.
And the market valuation may be like the dog on a leash, which is running up and down.
Right.
So we come back to this 13, 15% type earning trajectory, which typically gives us a double every 5 years. It's the norm. And I don't think we are breaking that norm in a rush, especially as we financialize and we formalize. These guys should gain a lot more. So there's no reason for them to lose. And there's no reason to doubt India can continue growing at double-digit type of earning growth, which is the base case.
But you don't see a significant correction in this space because valuation.
See, correction is a valuation point is different from earnings.
Right.
That in terms of valuations, like again, if you think about it, 75% of the world's wealth has been created by maybe 100 companies. So it's not that every small company will become a mid-cap and every mid-cap will become a large.
Correct.
Real
So
mega wealth creation, sustainable happens there.
Right.
If you buy a small Infosys and it becomes a giant Infosys over the span of 20, 30 years, that's where you create your wealth.
Right.
But today these companies are in a cyclical upturn where you're making 50, 60% compounded return for a year or two and then you fall back.
Right.
So it happens in cyclicals. That doesn't mean it's earning contraction for the market.
Right.
It's the same analogy as the 2005, 2008 bull market, where the real estate, capital goods, power, all these had banner years, and they've come back after 15 years of a sleep. So allow them some time to enjoy their space in the sun. But a cyclical business is a cyclical business. We're not doubting that.
Fair enough. What's your take on the SME sector?
SME exchange rather than the sector.
Yeah.
It's like, my God, if the attention and care given to fixing the F&O space is given over there, I would think it would do a lot of good to a lot of people who, I don't know what is going on there. It is the biggest gambling den in town. At the same time, like I said, even for FNO, I cannot deny someone in a capitalist society the chance to come and try his luck with 5,000 rupees and buy some FNO and maybe he makes money. I don't want him to lose money, and therefore the thresholds which they are raising are appropriate.
Right.
The same thing applies to SMEs. Because someone is small, you can't deny the person the right to come and invite public. But the checks and balances which are required to take money from public, these have effectively become deposit-taking institutions.
Correct.
I mean, I'm just using that analogy.
Right.
Without the checks and balances put in place, which you get for the main board. So some people, I don't think, should be in the listed space at all, who are there. And I don't know under what circumstances this was created, what were the driving forces. I'm sure there were good reasons, but clearly the regulatory supervision, because this is left to the exchanges, I think, to go and list, and the exchanges don't have the capability to assess.
Correct.
The
And
investment
the
bankers
incentive structure is also completely...
Investment bankers' incentive is to go and sell the issue.
Correct.
And I don't know who's buying these, who's propping them up.
It's in the interest of exchanges also.
Yeah, so there's, like when you do capitalism, you need a proper regulatory oversight.
Right.
Otherwise it becomes robber barons.
Right.
So unless this architecture is kind of thought of, there is a case for wanting the small person to prosper, like we want small and mid-cap companies also to prosper. But it doesn't mean we allow them to go scot-free on most regulatory fronts.
So you would rather have SEBI directly have oversight on the
I don't know if
SMEs
they have
just
the
like you have?
capacity, because it's a capacity issue. It's like the judiciary, right? There are like 6 million plus cases in the high courts. There are probably 4 crore cases stuck at the lower levels. If we don't have the judicial capacity, then either we have to start using tech like AI, at least for the judiciary. That's my hope, that they will do it with AI and we clear this backlog. But I don't really have a good answer for the SME side.
Fair enough.
Maybe they just have to bide their time and go through private equity.
Right. Are you selling or buying in the market?
So as an investor, one is always like, for lack of a better term, we are farmers. We plant our seeds and we wait for the crop to grow. Some crops grow in this season, some crops grow in next season. So it's never that you harvest the whole crop in one stroke and go. And there's always things to do in this market because it's such a wide, exciting country with so many opportunities. When there's something overpriced, we typically tend to sell before they get very, very overpriced. And we typically tend to buy things which are borrowing a couple of years ahead of the market. So we are allowed to sit, and plus I don't like paying short-term gains tax. So I'm happier if it doesn't move for a year and then it moves.
Right.
So I hope that answers your question.
Okay, so I don't know if you're going to answer this, but I have to still ask, what is your Nifty prediction for next Diwali?
If we are,
you're not allowed to say 15%.
No. If we, I don't think we'll be 15% up. I think if we are double digits, I'll be very happy.
And what is the worst case?
The market is ahead of reality today in terms of valuations.
And
so
what's the worst
I'll be
case?
happier if it consolidates, so I don't have to sell some of my darling companies because they get overpriced, and I can continue enjoying their compounding for a period of time.
Right. And what's your worst case?
Look, worst case, you never know. When you get a 2008 type event, who's to say? And I think there is a debt blow up in the world around the corner. Now, it may not happen for the next 3 years. It may happen in the next 3 months. In the short run, Donald Trump wins the elections, let's say the way the markets are predicting. He says, I want to put tariffs and I want to do tax cuts, and the dollar soons, and inflation rears up again because tariffs mean inflation, and it means broken trade chains, and that inflation gives rise to, hike in interest rates somewhere in the world, gold and platinum and all those, uranium, all these stocks going a bit bananas. What happens in that turmoil and how we navigate is to be seen. So the good news as a liquid market investor is I can have a view which changes in a week. I don't have to sit like a private equity guy and think 7 years. I tend to invest like that, but I can have a change of view in a week.
Sure. So first of all, what are your top 3 risks? So this is external. Is there anything internal that you fear?
There are 5 risks which I have top of my mind. Number 1 is predominantly is this debt. It is just unserviceable. And I just want to again elaborate that if your debt is 300% of GDP, and if you're paying even 3% on it, that's what, 9%? And if you're growing at 4%, that means your debt is compounding at a rate which there is no way you can service.
Correct,
Plus, the developed world has unfunded pension liabilities, healthcare liabilities,
Yeah.
and now increasing defense liabilities.
Right.
If they're writing $500 billion checks to Ukraine, it doesn't come for free.
Correct.
Someone is going to pay for all this. So that debt event is imminent. Geopolitical strife, because the great powers are now again fighting to posture, and this US-China fight, I hope we stay out as the neutral party and let them figure out what they're doing. But this is a real problem for the world, and two camps have happened. Third is internal politics in most countries have become very starkly divided. And what that does to breakdowns of societies and economies, I don't think we've seen. We saw it remotely as the breakdown of Soviet Union. But we haven't seen this happening in the developed world. Like if you go to France or you go to UK or you go to US, they have fractured societies. So what does this mean for the world? What if you have an Arab Spring over there or a Bangladesh type of thing in one of these countries? We don't know. So debt, geopolitics, internal politics, climate change, which we know if Bangalore can get flooded and you're thinking I'm going to compound and you can't even work from home, what happens to you? Stuff like that. And number 5 is the biggest imminent threat to India is tech. The disruption happening there. If the world's going to be AI enabled in the next 4 or 5 years, what it means for our whole IT space, our GCC space, what does biotech mean for our entire pharmaceutical space, what it means for our manufacturing base to get robotics and sensors and AI enabled stuff is transformational. So what India will look like 5 years from now, we should be thinking about today and making those investments. But I don't think we are on that path, but maybe not fast enough. And both, I mean, from government as well as business perspective. And businesses as yet on technology, products and branding are not up the learning curve. We are still wanting to be processors. How many Indian brands can you think which travel well globally?
Right.
You think of few, like Tata's acquired, of course, JLR or Indian Hotels and service type companies. Maybe a Bajaj Auto will go and sell, but into second, third world markets. But if a country rises and we're becoming third largest in the world, the rise of Japan, the rise of Germany, the rise of China meant the brands and the products went global. And we're still far away from that. So to me, these are really the things I wish and hope for to see.
Is geopolitics today an impediment to that?
It
to
is.
Importing growth? It
is. Because your export market is clearly fractured. Geopolitics is holding back your FTAs. You would be part of ASEAN otherwise, right? If China truly wanted to have a West versus East fight, it's stupid what they did in Ladakh. If China and India came together, if they are largely a Pacific Ocean facing society, and we are largely an Arabian and Indian Ocean facing society, there is no conflict, there's the Himalayas between them. There's never going to be land warfare really. And what they wanted was Tibet for water, which they already have control of. So there's no real fight between India and China. And the slowdown which they have in China, we were the natural market to take those products. And we were the natural market to supply the declining demographics of the world. So if the world is not going to open up the labor market to us and we are not going to open the Chinese market for products, trade is not going to move freely. And that fractured trade is what leads to inflation. And that's what leads to destruction of financial assets at the expense of hard assets. So I'm hoping none of this happens and saner voices prevail. But that's the world we are actually India is positioned so well. We are not actually enemies with anyone. We are there to supply labor, markets and brain power to the whole world. And we've never been a country which has projected power. We've projected culture and art and science, but we've not projected power in the meaning of conquest. So I think more and more of the world realizes this. We are a natural reception point of the world for capital. And I still remain very, very hopeful that that capital will find its way here and we will use it very, very productively.
And any 3 sectors or themes that you think are still attractive? I mean, they've not priced in future growth fully.
I think this energy transition, India is short on energy. We are 20 years behind China on energy, we're 20 years behind on ports. So this is still to play out. Financialization is still to play out. Like we're getting scared already at 40-50 billion coming to equities and behaving as if it's at the expense of bank deposits. I think this has a lot of legs to run. There will be cyclical up and down. Like 2008, SBI and HDFC were up and asset managers were down. Now asset managers are up and SBI, HDFC are down.
Right.
But this will even out, and a larger proportion of our money will end up going to financial. So that to me still remains the central bet for India. And 3, I look very, very carefully for companies doing technology, products and branding. And there are enough of those still small, but hopefully 1 or 2 of them emerge and they can become very, very large.
Okay, fair enough. I think that's all from me, really. So, just since this is Diwali, describe to us what this year was like. If in a movie or a dialogue or a poem or something to describe how was 2024 for you, or just the year. What was 2024?
No, 24 for us, I mean, again, lot to be grateful for, and not just from stock market returns. We've have traveled a lot. Had a lot of good happy occasions in the family, so it's more like it was a heavenly year. So there's a romantic movie, my wife will laugh if she sees this, which we had seen years ago, called A Walk in the Clouds. You felt like you were floating in that sort of atmosphere. That's the year gone by, and for the year coming by, I hope here comes the sun. So all good things happen, which is the Beatles song.
Right. Although you didn't sound like the sun is coming.
No, it's always darkest before dawn.
Right.
And I don't think this is twilight where it's going to become dark.
Right.
So for India, I think the dawn is still there. We are in the best period of our life, the next 20 years. And the collective destiny of 1.5 billion people can't be bad. It's good people, meaning well for the world. So
that
good things
any
will happen.
country can say anything.
I don't think every country can say that. Look across us. Look at our neighborhood.
Okay, on that cheerful note, thank
Sure.
you so much,
Always.
Manish, for
Thanks
talking
having
to
me.
us today.
Thank you.
Thank you.